Greg, I feel like you don't buy into all the partying going on surrounding the latest softer than expected inflation reads.
No, I don't. And I find very little to celebrate here, despite the market thinking otherwise. At the end of the day, we only saw meaningful progress against energy and airline fares. And so, we have little to confirm that the Fed acted swiftly enough, which I think most of us agree that they didn't. Many of us encouraging them to raise rates in the back half and back quarter of 2021, but also that they haven't acted aggressively enough. And I think that this will become apparent as they come out of Jackson Hole. James Bullard, wherever he finds a microphone at this point, has been walking back what Jerome Powell intimated to the market a couple of weeks ago, essentially giving the green light to put risk back on by saying we'd like to see a Fed funds rate of 4% by December, and we'd like for that to be front loaded. I don't think the market's pricing that in. I also think that the market no longer prices in a recession. Recall in January, I said that because largely the Fed hadn't raised rates in 2021, that we would probably face the risk of a recession this year. Technically, I guess we're in one, but I do believe that that will deepen as we enter into the back of the year as well.
It's interesting because I think that there has been some debate over whether or not Jerome Powell a couple weeks back was actually hawkish or dovish, Alicia. Regardless of where you stand on that, though, you think that the Fed has a long way to go still, and we shouldn't buy into this risk-on sort of tilt.
So, look, the rally in the last 6 to 8 weeks really has been driven by the bond market and the precipitous drop in yields from about 340 to 250. And once we were under 3%, that's really when you saw growth stocks take off and outperform cyclicals. So let's take the thinking a little bit further. We do think that inflation is going to be sticky on the wages and the rental side for housing, clearly. And so the question you have to ask is, why is it that yields have dropped so dramatically, driving the multiple in the market? And the answer is because the bond market is pricing in pretty significant slowdown in the economy, so much so that it's pricing in cuts next year. So if we think that, what does that mean for earnings? And so we're back to the same issue of, yes, the rally was great. Our clients are always invested. We don't trade markets. So all our clients participated in this rally, which is great. The question you have to ask is, while earnings season was better than feared, going forward, you can't believe the bond market is right and the equity market is right at the same time, looking forward the next 12 months.
Right. I mean, I definitely buy into the notion that the 10-year yield is pricing in something not so great for the economy, Greg, but at the same time, it has still been the green light for particularly tech stocks, particularly high growth stocks. That is what we have seen go on in the past 6 to 8 weeks in particular. And so how do you sort of separate, what your beliefs may be fundamentally about the economy with what the trading environment has signaled to you?
So sequence is important here, Melissa, and your time frame, your duration is important as well. And so, for a colleague who has someone invested 100% all the time, you look for the things that can ride through an environment like this that has macro challenges, that may have some policy challenges upcoming. And so there are lots of great companies over the near term. Look at the travel and entertainment sector, energy, some select financials that have work that will continue that have a durable top line, in some cases tethered to secular tailwinds. And those names will continue to work throughout those challenges. But sequentially, what we're going to need to go through is the market understanding that we have not yet reached peak Fed hawkishness. That will be something that the market will digest in September. And subsequent to that, I think the bond market is right. The market will digest a deepening recession for the back half of this year. And there are going to be companies that are more subject and more exposed to that than others. That will be the opportunity once that's behind us, once that headwind. Remember, there were many headwinds I was looking for this year. I was looking for peak inflation. That will be behind us at the end of the year. I was looking for peak Fed hawkishness. That will be behind us. I was looking for significant downward analyst revisions, and I think that we still have some yet to encounter in that for 2023 numbers, but that will be largely behind us. And so your sequence is important here in terms of the duration of your investment and your time frame.